and just start talking. So it's pretty laid back.
That's great.
Into that.
Dude, hit it, Hayden.
Let's do it. All right, in 3, 2, 1.
Welcome back to another episode of Unscripted Exchanges. We are super excited to have a guest on here, special guest, VIP guest, Mr. Patrick Henshaw. Patrick has been a mentor of mine. He's been in the startup and VC game forever. I think I met Patrick. I think I met you back when I was like 19 or 20. And I was like, I pitched him the idea, my first startup idea. And he's like, oh, have you thought of this? Have you thought of that? So we're super excited to have Patrick on here. He is very well versed in venture capital, fundraising, startups, business growth. He currently runs a Render Capital and Render. They are out of Louisville, Kentucky. Render Capital is a early stage investment fund working with mostly early stage companies. They do have, I'll plug this real fast for you, Patrick. They have a competition going on called the Render Competition. There are 8 startups that, correct me if I'm wrong, will get $100,000 each. As part of this competition, the applications are open until May 14th. They're live right now. They're going on. So get in there, apply, and you get the chance at winning $100,000 and working with Render and Render Capital and Mr. Patrick Henshaw. So just a lot of cool stuff going on. I know we'll get more into it, but I wanted to hopefully make a good introduction for you, Patrick, and say we're excited to have you.
Yeah, thanks, Hayden. Thanks, Cole, for having me on. This is exciting.
Can't wait for today. I mean, we've got a lot of good questions and topics that we want to dive into. And again, really appreciate you carving out time out of your busy schedule. Cole, do you want to start with the first topic or question?
I want to give Patrick an opportunity to introduce himself. So I'm going to make this very simple because, a lot of the times when you say, hey, introduce yourself, it's like, okay, great. Like, you want to tell me the whole story. Patrick, can you give us a background maybe around your work recently with venture capital fundraising, what you guys are doing at Render Capital, and kind of your summarize as much as you want, your story and how you kind of got into the startup environment.
Oh, man. Well, it's too early in the day to dive into the bourbon that's behind me to go through the whole story. But I guess starting with nearer term, yeah, so Cole, you hit the nail on the head. We're Render and Render Capital. So a couple cool things before we dive into there. We're service-disabled veteran owned. I had a first life in the Army, which we can get into later. We're also a certified B Corp, which is pretty important to how and where we operate, and we're a public benefit corporation. So our mission is to drive impact through innovation to enable human flourishing. And we do that really in 2 ways. And you mentioned both of them, Cole. The first is Render Capital. So we have about 30 million under management there. We work across different capital stacks. So we have everything from grants for Black and Brown founders to crowdfunded equity matching through our partners at WeFunder, to venture debt, to traditional debt with our partners at Community Ventures, all the way through into the competition, which you mentioned. Every year we invest about $800,000 all in one night at Lynn Family Stadium, the soccer stadium here in Louisville, which is pretty cool. And then we've got a traditional early stage venture fund where we invest anywhere in the Midwest and South, I say, in things that make sense for the Midwest and South, which is fun. And then on the other side of the house is our corporate innovation studio. So we're management consultants largely for Fortune 100s, middle market companies, even some government agencies, universities, and large nonprofits. And really the byline there is we help them work with startups and help them work like startups.
Okay.
So that's Render today. And like I said, the whole rest of the background is quite a story, but it started off in Houston, Texas, traveled through Afghanistan looking for roadside bombs, ended up managing billion-dollar programs, and then loved and hated the bureaucracy of the military. So got out and started and exited 3 different businesses. So,
wow.
I told you his story's sweet.
We appreciate your service, by the way, too.
He's really got bourbon in the coffee cup. He's just saying that.
I do have 2 coffee cups. Just our director of product was like, "What are you putting coffee in both of those?" I was like, "No, one is water."
Well, I've been taking a few notes ahead of time, and just as you were sharing some of your opening story there, I guess for some of our listeners that might not know a whole bunch, and I'll raise my hand myself, I'm not going to act like I know a ton. When someone comes to you, when you say that you've got a $30 million portfolio to invest in a whole bunch of different companies, when you're looking for raising this capital, how does that like pitch go for the people that have the money and they're willing to put into that portfolio? Does that question make sense?
Yeah, totally. Yeah, and it's a question that I honestly didn't know the answer to until when Cole and I first met. So back when I exited my last company, I moved from San Francisco to Cincinnati in 2016 and joined the fund of funds there called Centrifuge. So we grew that from about 30 million to 150 million.
Wow.
And our investors at Centrifuge were Kroger and Procter and Gamble, Michelman, St. Elizabeth's Healthcare, Children's Hospital. And our pledge really was two types of return on or ROI, right? One was return on investment. We were giving those corporations back money. I'll get into how we did that more in detail. But then the other was return on innovation. And so the question around fundraising, I like I said, built and exited 3 different companies. The third was venture backed. And I thought every VC was an arrogant a-hole who had no bosses. Now, a couple of those statements might be true, but they all had bosses.
Okay.
Because little did I know, coming into Centrifuge, Centrifuge as a fund of funds, we were actually investors into those venture funds. So, Lear Hippo and Madrona and SV Health and Mercury Fund, all these top quartile firms, I now at Render Capital, I've got to pitch to high net worth individuals, family offices, and fund of funds, and even some private equity backed firms to do what we do so we can unlock capital, right? And it is almost exactly the same as raising for a startup. You're going to have 200 meetings. You're going to have 50 in-person sessions, and you're going to get a couple dozen people say yes to you, right? And you run it just like Cole ran sales processes and run sales processes, right? You've got a pipeline, you've got to fit a thesis area, you've got to fit a product, but ultimately at the end of the day, you've got to follow up and follow through and be true to who you are and true to your thesis area, and that's how you unlock that capital from those individuals or offices.
That's awesome. And when you were mentioning that when you're working through the fundraising rounds here and gathering, that large portfolio or lump sum of money through high net worth individuals, is there a minimum that someone would have to contribute to that portfolio or that fundraising?
Yeah, so it's a good question. I'll answer that in 2 ways. And the SEC is working on changing some of these regulations at a federal level, to be clear. So unfortunately, right now, the only individuals that can invest in a vehicle like Render Capital are what's considered accredited investors by the SEC. You have to have a certain amount of net worth or a certain amount of net earnings over the last 3 years to be able to even unlock this capital.
Right.
We won't get into why I'm not running for politics, but politicians need to change this stuff, because why are we not allowing access to one of the highest performing asset classes that's available in our capitalistic society? But oh, by the way, small side tangent, that's why we developed our partnership with WeFunder and why we've committed about $1.5 million in capital onto the WeFunder platform, because we want unaccredited investors to be able to invest alongside an institutional investment fund, right? That's what me and my whole team does all day, is find and source deals. So the other side of that equation too is a direct answer to your question is it's all up to the portfolio manager, the GP or managing director like me on their minimums. For us, we've got a $500,000 minimum. And now the caveat to that is, unlike a real estate deal or a startup individual investment or an angel investment, that 500K that are up to, some of our LPs have committed up to $5 million. That capital commitment is over 5 years.
Okay.
So they keep their money in whatever asset class or portfolio or managed ability that they do, typically with a family office manager or a private wealth office manager or whatever. And then once every quarter or so, when we make investments, then I call that capital. Hey, everybody, I need 250 grand because we're investing in, I think we just went public with this, so I can say it, Zero Carb, the pizza crust, right? So they're an awesome company out of Evansville. Pizza crust made out of 4 ingredients: chicken breast, salt, pepper, and eggs. They're
Ooh.
growing and scaling like hotcakes. I don't know if their recent 400 store launch is public, but I'll just leave it at that. And maybe we can include a link later, but super exciting stuff that's happening there. So that's when I would call capital for my investors. So I'm not calling all that, 15, 30, whatever $1 million upfront.
So you're basically saying, hey, I'm just understanding the way it works with you guys, how you manage it is you'll have a 5-year period. Say, hey, over the next 5 years, what are you willing to contribute? A 1.5, 1 million, 500,000 is your minimum, and then you don't just say, hey, wire me the money today. You say, hey, when I need it, I'll let you know. You got to set that aside, and I can come after that within the next 5 years. Now, my next question to you, then following up on that, and for our, because you got into a lot, Patrick, about and I totally agree with the accredited investors and how they're kind of like they're given this priority, and then you've got like
Yep.
crowdfunder and Kickstarter and some and places that have tried to kind of fill the gap. They haven't been able to totally bridge the gap, but they've tried to fill that gap for people like everyday Joes to be able to invest in
Mm-hmm.
something that, like you said, could be the highest rate of return. Right? You invest in a
Exactly.
company. Let's say you only have $50,000 to invest, and that's something you pull out and the company takes off, right? That could be a huge win, right? That could change your
Totally.
life. And it's like where people are not being able to do that, even though it's their money, right? It's
Yeah.
totally agree with and we don't have to get into that, but I totally agree with that. Um, yeah, we get on a rabbit hole. But I guess my question to you is for investors that are investing through your programs and through your fund, what is their expectation? Like, what kind of, and you don't have to get too into the weeds, but like, what kind of expectations can they have on, like, do they have to wait? Because I mean, we all, and we'll probably get into the SVB, later on, maybe get your thoughts on
Sure.
that. Um, but even going back to the Bernie Madoff, when he, all of a sudden people started pulling money out of his, and that's why his Ponzi scheme collapsed because everybody started getting
Yep.
scared, and he didn't have enough cash to cover the deposit, like the cash out, right?
Yep.
And my question to you is like, how do you manage that as a fund? How do you manage that? Hey, once we've taken our full $500,000 in this 5-year period, do you have agreements or say, hey, this is where it's going, and you can't pull that money out for this a certain amount of period of time?
That's right. Yeah, and a couple different kind of tactical pieces there. One, even preempting all that, one of the reasons why we don't call all that capital at the beginning is one of the most important metrics for a venture capitalist or any investment, whether it's real estate or whatever, is this calculus called the internal rate of return. Basically, the velocity of your capital making money on your money,
Mm-hmm.
right? So if I pull all that, 15, 30 million today, I'm not deploying it immediately into companies that are increasing their share value, right? So that's why we leave it with them, and we say we're only going to take that money when we are investing in a company that is fast growing. The second piece of that is re-expectations, and I'm super transparent here because we've got a mantra at Render of trust, transparency, and communication. Right, what happened with Bernie Madoff and a lot of these other, frankly, scammers was they weren't transparent,
Mm-hmm.
they didn't communicate, and they shouldn't have been trusted, right? And
Right.
so how we manage that is, one, we're out front and we say, hey, this asset class, oh, by the way, which should only make up anywhere from 5 to 7 of your total net worth, this high risk, high reward category, it is high risk, right? But it is high reward, right? So just for example's sake, if we invest in 20 companies at an early stage venture fund, what we tell our investors is anywhere from 12 to 15 of those companies will fly straight into the wall. They're going to go bankrupt. They're going to go out of business. They're not going to do anything, right? 2 to 3 of those 20 might give us our money back, right? They might give us the 250 grand to 1.5 million that we put into them over the life cycle of their investment cycle back. And where really you'll hear this term called the fund earners. Those are the 1 or 2 companies that pay back the entirety of that fund anywhere from 5, 10, 20x of that, right?
Uh-huh.
And so that's where we're getting in, is we're getting equity, or we're getting promises through a vehicle called a SAFE, a secure agreement for future equity. We're buying equity in that company for that payday at the end of the day. And we're also transparent too. The typical lockup period for our early stage investments is anywhere from 7 to 10 years, right? And that's typically how long it takes what we call a high growth startup, from time of founding and early institutional investment to when they undergo a transaction or an exit activity where they either SPAC or go public, or they're merged or acquired by a strategic investor, private equity firm, or a corporation.
Well, I love the transparency there. I mean, the way you're describing how you guys go about it is it's very black and white. You're saying, "Hey, we understand there's a lot of risk. There's not the amount it's and you're even saying, to simplify, it's a numbers game. We get 20
Yeah.
startups, hopefully 2 to 3 make it. It's the 80-20 rule, right? 80%
right.
of your sales come from 20% of your clients, maybe even a little less, right? You're going to make your nut, and that's why you got to diversify too. You got to spread that out to find the right ones. I just love that message you've got there, and I think that for our listeners and for me, it makes it very clear on how a capital firm such as Render Capital should manage the funds of
That's
their
right.
investors and should invest in startups. That's the way to do it. That's the way to not only gain trust and gain and help startups, but you're also like you're building a brand that I think is trustworthy. It's phenomenal. It's awesome.
Yeah. Well, thanks for that. And the other caveat there too is, I didn't know this when I first started raising money from VCs, is most firms, ours included, much of the capital is the individual GPs or managing directors. So this is my money going into this fund too. It's not just me being a portfolio manager of only somebody else's money and I'm making a bunch of salary off of the thing,
You
right?
got skin
This
in the
is my
game.
own personal money, 100%, right? And that's why, and how that drives our conviction forward is obviously me and Mike, my operating partner, and Tret Nguyen, our new senior associate. This is what brings us the conviction to invest in those companies, is our operational background, but also the cash that's in it from us as well.
You gotta be. You're not just putting up other people's money. It's like, okay, like
No.
this is, yeah. That's
Well, that's how you build transparency and credibility, is what I'm
Mhm.
hearing, I think, which is awesome. That's fantastic, which sounds
Yeah,
like that's one of you. Go ahead.
the other tactical side note too, and small plug for one of my favorite folks in the venture landscape, is we use this platform called Visible VC. It's visible.vc, founded by a guy named Mike Preuss out of Chicago originally. He was one of the OG high alpha companies actually back in the day, which now high alpha has swelled to over, I think, $500 million under management. But they do a great job, not only for GPs or general partners funds like me, but also to help startups be transparent in how and where they're reporting their metrics and cash flow and all that kind of fun stuff. So it's a great platform.
That's awesome.
I gotta check that out. That's super killer. So I want to. You have any questions or comments you want to make? Because
I got one comment, and then I got a question that I'll jump
You
into.
go first.
Yeah, I mean, first off, I'm learning a ton here, a lot of new acronyms as well. I'm jotting
Oh,
down
yeah.
notes in real
And
time.
I'm trying to spell them all out because I
No,
know
I
it's like
appreciate
speaking
it.
Vulcan speak.
No, like I said, this has been
I
great.
gotta do that now. We'll sign off with the Vulcan. Yep.
Yeah, exactly.
This might be taking the conversation in a slightly different direction, but just what has been your favorite investment personally that you've made, or maybe that the firm has made, Render Capital? And do you mind sharing that?
And that's like asking a parent to pick their favorite
I was about
kid.
to say you're like.
Hey, I
Yeah.
ask the tough questions over here.
Man. Well, I'll tell you, my favorite kid is right behind me because we only have one. But man, that's tough. They're all so interesting and unique.
Maybe not
Zero
favorite. Let me make
Carb
this
is
easy for you. Not favorite. Just pick one that you thought was really interesting.
Yeah, there we go. Thank you for refining my question.
I mean, we talked earlier in the pre-show, but Resound FM is pretty cool. So they take the ums and the ahs out of podcasting, which obviously I need help with. But it helps take the producer's time, break it and
Yeah,
cut
that's
it down by
huge.
80 or 90%, which is pretty cool. We don't invest in bourbon, even though there's a ton of bourbon behind me. But we have this awesome company called Alt Distilling. Their brand is called Naked Lady, and it's basically a spiritless spirit. And it's intended to be an edgy brand, so you can still be a part of the party, but instead of ordering something a virgin or non-alc or whatever, you can order at the bar, give it to me naked. So that's another pretty cool one.
So it's
I mean,
non-alcoholic.
they're all awesome.
It's non-alcoholic,
Yes,
right?
it is non-alcoholic. They literally distill the spirit from the spirit. So it's pretty cool.
Okay, you just first of all, I didn't have to jump in because Hayden knows how much I love not. So I don't drink, but I drink non-alcoholic beers. Like I love non-alcoholic drinks, like non-alcoholic IPAs, non-alcoholic like mixed drink. I mean, I'll go out and it's like I'll kill a 12 pack of, and everybody like, and most people don't know they're like non-alcoholic drinks. So they're like, man, dude, how are you doing so well? I'm just like, man, I just hold my alcohol better than you. That's all, I guess. Um, but I just that whole game. And I didn't know that existed. Like I wrote, I mean, I'm literally going to go order some of that as soon as we get off this podcast. Can you order it online?
Yeah, you can get it at most Total Wines. And a real quick answer to your question is that's one of the reasons why we invested in them. Because if you're familiar with the alcohol space, the U.S. basically dictates above a certain ABV, you have to go through what's called this third tier system, right? You
Mm-hmm.
basically have to use a broker to get it in the hands of consumers. But because there's no alcohol in it, you can sell direct to consumers and you can put it on shelves wherever you want to. So it's pretty fascinating.
Yeah, I mean that's just got me hyped. I had to cut in for that because I'm a huge fan of the space. I want to get into this space. I was actually just like the other day I called Hayden. I said I'm drinking these brew dogs out of Cincinnati. I said I got that's my favorite. Them and Athletic. Athletic's got an awesome
Yep.
story too. We've been working on a partnership with them, but I absolutely just love being able to go have a drink like that, feel like I'm participating. I'm like this all the time, right? So I can go out and have fun,
Yeah.
kill my NAs, and my wife, I can drive my wife home from the bar. Like it's perfect, right? Like we're good to go.
Yep.
So I called him the other day. I'm like, dude, we got to come up with one. Like we gotta have a UE like non-alcoholic IPA.
I mean, I'm
I
I'm
love it.
sure that space is doubled, if not tripled. I don't have numbers in
Oh
front of
yeah,
me,
it's
but
huge.
It's going
NA's,
nuts.
yeah, is going bonkers for
Yeah.
sure.
Well, and to your point, Aiden, I think I'll lens the favorite company and really what's down the fairway for us in the kind of equity investing space is companies like that I mentioned in our portfolio that are typically growing 30% quarter over quarter in metrics that matter for them, right? Whether that's revenue or monthly active users or whatever that category is. And then the target would be that they're doubling or tripling year over year, right? And without getting into numbers for zero carb, they basically did exactly that over the last couple of years. And I mentioned this, 400 stores launch that they're about to go public with. Their most recent investment round, which they just went public with. Those guys are, funnily enough, selling like hotcakes, but they're selling back to the non-alcohol all space. People who want pizza want to eat pizza, but they want to eat pizza in a healthy way,
Mm-hmm.
right? And so that's how they're changing the landscape on that side.
That's awesome. One other thought as you were describing that, another like buzzword, and I'm a former analyst for Kroger, MAU, so monthly active users. Like, do you guys have a certain set of criteria or KPIs that you guys look for in companies? And are you willing to share a couple of those KPIs?
Yeah, so it all depends on their business model and their go-to-market. So as an example, one of our other awesome portfolio companies is called V Simple. They're basically building the operating system for the future for middle market companies.
Mm.
So while we want to see monthly active user growth there, what we're more concerned with or more fascinated with them is how much time inside the platform their super users are spending.
Mm-hmm.
Right. If you think about Zoom or Slack or Gmail or whatever, SaaS-based businesses, on a business to business level, that's a really important thing for them, right? How much time are you spending in Slack? How much time are you spending in Notion or Asana or whatever, right? So that's a key piece. The other side of the house, which marketplaces are really hard for us. We don't invest in dual-sided marketplaces, but user growth is important. The caveat is sometimes we consider a lot of that user growth as a vanity metric, because and why we relegate it back to monthly active users. You could have 150,000 users, but only 10 of them log on each month or each day or whatever,
Yep.
right? So really, the kind of net of that question, or the answer to that, is really how sticky your product is. How necessary are you to their business or to their daily life or to their impact, for them to not give up that product and easily go somewhere else.
That makes a lot of sense. You look like you got another question that
I
you're thinking
always
of
got
over
stuff
there.
to say, but you had some good questions. I'll let you keep rolling with it.
I don't want to steal the show from you.
Dude, go ahead. Steal the show.
Again, kind of taking us down maybe a little bit of a different route. In terms of, all the companies that you've worked with or you've just observed personally, what would you say most companies should either stay away from, or where do you see startups go wrong that a lot of people just don't think about for whatever reason? It's like, hey, if more people knew about this, it could help, save your company, save, your stress levels, etc.
Yeah, I would say the number one thing that's pervasive, whatever business model, market, industry that you're into or building into, is especially first-time founders, right? Because if you've done this before, even if you failed, you learn some of this stuff. But the number one thing, from my perspective and experience, of why companies fail is they are too busy building a product and not building a solution, right? And what happens is when you're building that product, it's the figurative analogy of a hammer looking for a nail. And after a while, when you're struggling, everything looks like a hammer, everything looks like a nail, right? And then you're just destructive, right? And you're not actually building a solution to an opportunity set and a need. And especially in the B2B space, we coach and talk with founders a lot. Who is your P&L holder, right? Who has money today in a line item today that you can go get money out of their P&L and put it into your pocket, right? And a lot of companies are like, oh, this is the newest and greatest, and what a literally blah. And it's like, well, who's going to pay for that, and how are they going to pay for that, and do they have a budget line item for it? And sometimes that does need to be scripted. Like they need to help coach the corporate into, hey, this new spend should come from marketing, or should come from HR, or should come from whatever budget. But the but is they've got to identify the problem. They have to build a solution, not a product. And then the caveat to that is they've got to build a solution that there is budget and line item to pay for.
Well, I love that analogy, especially when you're talking about like P&Ls and having a line item for it, because from my sales background, and I'm very passionate about sales and business growth, but how you do that from a sales perspective. And the hardest sell is when somebody doesn't have budget for something and doesn't understand why they need it, right? So a lot of the times when they don't have a budget for it, they don't know they need it. So then you're going, especially when you're going to a bigger corporate company and saying, hey, even a small mom and pop, and you say, hey, this would change your business landscape. This could do this, this, and this. Here's your value prop. They go, okay, great, but I don't know where I'm gonna get money for it, right? I don't. So
That's
like
right.
they don't know. And then if you're really good, you can educate them. You can help them get there, but that's gonna drag your sales process out. Especially as a
Totally.
startup, you don't want to have that. Depending on what you're building, you don't want to have that 6 to 8 to 10 to 12 month sales process. You want something that you can do in 2 to 3 months, if not less, just depending on the size.
That's right.
And if you're looking at that longer sales process, now it's all like customer acquisition cost, right? If I got to spend eight to 10 months selling this, well, then my customer acquisition went way up. So that means my price has to go way up, or I make zero money. Well, then by the time you've raised your price to cover your customer acquisition cost, the customer doesn't want to buy it. because it's too expensive.
Exactly.
So
Yeah, so two pieces there. My wife Lydia, who's an amazing multi-time founder, she led product innovation for Procter and Gamble before she started and sold her last startup. But she's in the market now to buy a middle market company.
okay.
And one of the key pieces as a part of her search criteria for buying this middle market company is a low percentage of the P&L is spent on this product, service, or platform, and there is an outsized amount of return and daily usage for this product, service, and platform. And I'll say that differently. Basically, if you take up a large majority of their P&L, of their purchase, of their profit and loss, of their budget for this line item, and you're not producing infinite outsized returns for that, you're the fastest thing to get cut and chopped, right?
Yeah.
Or the fastest thing to be looked at for, hey, we can go to somebody else who's cheaper or faster or better or whatever and replace this, right?
Yep.
The other side of that, what we do, and really I took this from my time at Centrifuge on our corporate innovation side of the house. We're trying to streamline a lot of these pilots and stuff with corporations with how we interact with them. So one of the biggest problems that I had with my last startup was I won't name any names, but we got walked into the front door or side door of a large publicly traded consumer packaged goods company out of the city of Cincinnati, and we were offered a $15,000 pilot. Which that's great, cool. We get a logo on a slide, pump it through, get the thing, get some traction, whatever. That process, back to what you were saying, that sales process for us, not only did it last 6 to 9 months, but it cost us $80,000 in legal fees to get through that. So what we do differently at Render is we actually, and it's helpful too that we're service disabled veteran owned. We go in as that basically general contractor. So we have large bulk contracts with, Cumanas and Louisville Waters and whoever of the world. And then they tell us their problem sets. And then we walk that startup in the side door. And it's not big corporate mega overlord that's paying that startup. It's Render. So they don't have to go through legal and procurement, and my freaking fingerprints are on file at some of these big corporates that we work with, right? So we validate and verify the problem from the corporation, and then we actually end up paying the startup to help streamline that process. And if it doesn't work out, that's great. Internal legal didn't spend the 6 to 9 months in procurement and, whatever. And the startup got their money, right? They got their 50 or 150 grand in a pilot or whatever. And if it does work out, the awesome thing about that is now there's an innovation champion internal to that corporation that says, hey, they solve a big problem, they're cost effective, and I'm going to now, as that internal champion to this corporate, I'm going to now walk that startup in the front door and hold their hand through the whole procurement process.
We're cutting that because I love the strategy behind that. That is absolutely genius. I wish everybody listening would just write that down, clip it, listen to it 5 or 6 times, because a lot of the times going and pounding on the front door is great. You got to do that sometimes, but what you really want to do, especially when you want to scale or grow a business, is find a champion, figure out a way to get in there with a low, and the biggest thing I'm hearing, it's low risk. You're saying, hey, Render, we'll take the risk. It's low risk for you, P&G, whoever it is, I'm starting names out there. It's low risk for you. We're going to take the brunt end of it, but you know us. You know what we do. We'll pay for it. And now you've got proof. You've shortened the timeline. And now you've got somebody that's going, I didn't have to, because the biggest thing you don't do is, like you said, the innovation champion doesn't have to stick his neck out. Most people in corporate environments don't want to stick their neck out, especially if it goes wrong. They don't want, they'll say they will. They'll talk the talk, and that's nothing wrong with it. It's not a knock. But at the end of the day, if they're not going to go push something that they know could come back and really hurt them. But if you make it really easy, they can come and say, hey, I didn't have to go jump through hoops, stick my neck out there. But hey, I got these results. Check this out, right?
That's right.
They're way
they're
more
not
invested.
incentivized to take risks in any way, shape, or form.
I love
and so that's what we say too is Render helps de-risk innovation, right? As we get to be that third party vetter, we've got the network and the experience and the background to be able to do that and take the risk off of their shoulders. And sometimes too, and I get it. And, we did this in my first company too. We also can lay down and, put our arms down and be the big, bad, dirty vendor on the outside. Well, Render screwed this one up, right? Well, what I did when we accepted, air quotes, that we screwed up, right, or had a bad pilot, is I just got massive brownie points with my innovation champion internally, right? Because they got to point the blame at somebody else. And then conversely, what we do, if it is successful, we turn it straight back to the innovation chip. Well, this was all, Sheila's idea or Frank's idea. Like, those guys are crushing it, right? That's really how we are able to de-risk that side of the house, but also, frankly, increase the speed of innovation, right? Because a lot of these corporations, they're getting outpaced and outrun by these, 1,000 different ankle biter brands that are growing faster than them. So that's what we're trying to do, is help them speed access and de-risk the access to innovation.
It gets me jacked up. You know that, Hayden. Hayden's looking over at me. I love it. I love every piece of that. I think the really cool thing too, and maybe a question for you, is when you guys are going in and working with startups and working through this process, what type of reaction do you get? I mean, are most of your founders come from sales background? They come from engineering background? Like, what's your mix? And then, what do you look for when you've got the opportunity to do this? Like, what kind of startup founder are you looking for?
Yeah, so I would say the most successful startup founders that we have seen have lived experience, right, with that problem set that they're trying to solve.
Mm-hmm.
Ideally, they have had some type of risk-taking or entrepreneurial efforts in their past as well, whether that's founding a company or starting a business, or even sometimes that includes taking internal risks at a corporation before they jump and move into the entrepreneurial sector. But the really biggest thing that we look for is a founder that's coachable and able to consume and synthesize quickly, right? And Cole, you and I have talked about this before, but never in my life, growing up in the pretty cruddy neighborhood that I did in Houston, Texas, did I ever think that I would be sitting as a VC investing in companies, right?
Mm-hmm.
The only reason from my own perspective why that happened was my network, right? And me being able to consume and synthesize and do what you guys are doing, which is helping your listeners consume more and get exposed more, right? And we talk about this a lot, even on the investing side of the house. So we just launched an angel education network that's open to anyone. All your listeners are welcome to join. We partnered with the National Angel Capital Association to launch this programming. And the big thing was around, it's not that people are uneducated, right? It's not that we're not smart humans, right? It's that we're unexposed,
Mm-hmm.
right? We don't know because we haven't been exposed to it, right? I didn't know this back when I started my company, right? And started those companies. I had no idea what the world of venture capital looked like. I thought it was like being Mr. Wonderful on Shark Tank, right? And that guy is arrogant, doesn't have a boss, and all the other negative caveats I made earlier. But that's really the big piece, right? Is founders being coachable, having lived experience in the problem area and the solution set that they're building, and then being open to network and consuming concepts, capital, customers, and talent from all over.
It's extremely insightful. That's clippable. I'm already thinking of flipping that. I love that information. That's extremely valuable for us and our listeners.
I can keep rattling off, Hayden. Go ahead.
So I'm going to jump back to a topic and a question from this. You were mentioning your wife's kind of in the market looking to, I believe, purchase a middle market company. Correct me if I'm wrong.
Yep.
What is the definition of a middle market company? And then like, where would one kind of start to look for companies like that? Because Cole and I have kind of discussed some things offline and just curious to pick your brain. And if you don't want to answer that, that's fine too.
No, again, I'm totally transparent. So I'll take a step back and up. So there is this monster trend, not trend, really movement across the U.S. where over this next 10-year period, we are about to have the largest transference of wealth in our nation's history to the tune of $16 trillion. Yes, that's with a T, right? And what this is these are entrepreneurs and family-owned businesses that are either on their first or second generation of founding. And there's one of two pathways that's happening. One, their kid or their partner doesn't want to take it over. And two, they're looking for an exit pathway, right? Well, the macro trend that we're seeing, that Lydia is seeing, is that there's a bunch of private equity groups that are being spun up around this, and they're purchasing what I would call like upper middle market companies. So these are, companies that are doing 50, 75, 100 million in top line revenue. Those are great for these, multi-billion or multi-$100 million funds to buy and acquire and create operational efficiencies. Well, this lower middle market really is in the $50 million a year in top line revenue. As strange as this sounds, that is too small for a private equity firm to purchase.
Wow.
Number one. Number two, it's typically too small for to just outlay their own personal cash or net worth to go purchase. And so, direct answer to your question, how do you find it? How do you fund it? How do you source it? There are broker dealers that help with that, much like a real estate agent, right? There's a whole sub industry of business buyers and sellers that do this. The second is there's this swell of websites like Biz Buy Sell and Micro Acquire that are helping be more transparent and specific in connecting these pieces. But at the end of the day, lower middle market, how Lydia is quantifying that, really is a business that's in the $2 to $50 million in top line revenue a year.
That's awesome. I appreciate you diving into that detail there. And I kind of had an assumption in terms of what that was, and we've seen some stuff. We actually have been following a page on one of our social platforms called Unconventional Acquisitions, and they kind of break down things similar to what you were describing, which is just fascinating. And to your point,
and one of my favorite new buzzwords is entrepreneurship by acquisition.
Yeah,
I love it.
Right. You don't. I mean, obviously,
you're de-risking, right?
Capital if you are starting a business. Totally, yeah. But if you're looking, and this is really where it ends up at the end of the day for these long-term lifestyle business. From our perspective, that's a great way to grow that. Now, on the other side of the equation, on the venture capital side, and just to put a pin in this on expectations and returns, not only for the funders, founders, and my investors, is if you take venture capital, the expectation is that you are done as a founder and CEO within that 7 to 10 year time horizon. Right?
Like you're out. You're supposed to exit.
You're done. The business is sold. You've made an exit. You've gotten a bunch of money. You've made your investors a bunch of money. That's how the venture capital landscape works, right? The private equity landscape, on the other hand, is more focused on dividends and cash and EBITDA, or basically margin for that business. So the dividends are basically the cash disbursements year over year.
Yeah, they're cash flowing. It's all about cash flow.
Exactly. So
yeah, that space and one of the things Hayden mentioned, the unconventional acquisitions, is, I mean, they a lot of stuff they talk about, and I'm not a big follower of. I don't waste my time with platforms that don't give me something, with media outlets that don't give me and teach me something. Every now and then I'll watch the funny reels on Instagram just to waste time, knowing that I'm killing 45 minutes of my life I'll never get back, but I might laugh. Like, I like that. I'm okay with that. I'll admit that, right? But then I carve that time out. The point I'm trying to make is that where I think your wife's like, and and Patrick, you're going to have to put in a good word for us, so we're going to have her on the show too. Maybe we'll do a duel. We'll have both on again.
Hell yeah.
Is the acquisition of existing businesses. And they've posted a lot about this, and I've done some digging. The amount of people over the next decade that are going to be retiring, that are running multi-million-dollar businesses, that are profiting, 50, 60%. I mean, killing it, whether it's a heating and cooling company or somebody that runs a few local laundromats or car washes, like stuff like that they're crushing it. But the next, either they didn't have kids or they had kids that don't want to be a part of the business, or they just want to exit and retire, the amount of
Yep.
businesses that are available to purchase and acquire over the next 10 years, I think is like skyrocketing. And
It's huge.
people tend to go, well, I'm not an entrepreneur if I do that. It's like what's it's just like anything in life is relative. What does that really mean? Entrepreneur is what you make of it. Entrepreneurship
Yeah.
is determining your financial future and
That's right.
and running something, whether you acquire it, whether you started it from the ground zero. Like, it's all about, in my mind, if you do that, you can buy a business that's functioning, that's got a good name for themselves, maybe locally, put some operations in place, and scale it. And you're going into it making money. Versus it's tough to start something from ground zero. It's
That's
very,
right.
very, very tough.
Yeah. Yeah. The other interesting thing too is we're hearing and we're investing in a lot of these trends of the future of AI and ML. On the other side of the house, on the private equity, lower middle market side, there's businesses that for decades, maybe their processes might be disrupted by technology. But I've got a buddy, just as an anecdote, out in the San Francisco and the NorCal area. He just bought a gasket company. He's a fellow West Point grad. And one of the reasons why he bought it is you can't automate putting in a gasket, right? But what you can automate is your scheduling, your process orientation, your ARAP, right? That's what Be Simple does. One of our portfolio companies, right? That's why we're investing in the future of this. But you can't automate a guy or gal going in the field at Costco or Applebee's or Taco Bell or wherever to replace the gasket seal on the refrigerator. You just can't do that.
I love it. I love it. And what you're describing, he's looking at is, and you talked about this earlier when you were talking about, a company that's got a big bucket for on their P&Ls for this, right? If they've got a huge bucket, well, the first thing that company is going to do, if a new CEO starts over, they're reallocating budget for the next year, and they're saying, hey, we want to increase our margins. Well, there's only two ways to increase your margins. You either A, start selling stuff for higher prices, or B, cut your costs. Because you can increase your margins by cutting your operational expenses. So you look at, okay, where can we cut costs? Of course, you're going to look at the biggest budget line item.
That's right.
You're going to say, okay, let's go to here, 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 and here, and let's get money out of that. Because sometimes it's not as easy to increase your year-over-year growth, but you're like, hey, I can increase my bottom line if I get rid of some costs. So what it sounds like he's doing is, what he'll be able to do is maybe he can grow it and get it and grow it larger. But if he starts automating some things, some scheduling, some operations, some processes, then he can increase the bottom line. And that's what, I mean, at the end of the day, net income is what matters. And you want to be making money.
You got it.
Yeah, I mean, not every business or entrepreneur has to own a sexy business, as I would call it. I mean, as long as, and I'm oversimplifying, it's got a stable cash flow, and yeah, you are profitable. Like, why not try to de-risk, again, kind of going down the path of looking for a company that's already been established and someone's trying to sell it and you can acquire it. That might be, for any listener out there, maybe a more viable route versus starting something from scratch. Again, you got to pick your hard, and it just really depends on the situation. But there's a lot of great opportunities opening up over the next 10 years.
Pick your hard.
Yeah, I mean,
I haven't heard that.
Yeah.
We need to put that on the t-shirt. That was a good one.
You haven't heard that before?
No.
Come on, man. Come on.
I like it.
Another important question. I mean, these are all great questions and important questions, I think, in my mind. Cole and I are big on this. Work-life balance. You mentioned that you have a kid. How do you think of what a work-life balance means to you? And how do you kind of go about that on a given work week?
Yeah, it's a good question and constantly something that's top of mind and part of our culture here at Render. I've got an optimistic all boats will rise mentality, but I also have a realistic mentality of how and why talent leaves, right? And talent goes elsewhere, right? That's why at Render, we have we actually mirror similarly to Buffer, the social media scheduling platform. We mirror their revenue share agreement with their employees, right? And because I want to be able to reward longevity impact and time in our organization. But as a piece of that too, we've got unlimited vacation. We've got 2 mandatory weeks a year where we shut down the office over July 4th and over Christmas. We call it corporate rest. We mandate that, and then on the unlimited vacation side of the house, we actually track that. It's not just like you can leave whenever you. I mean, you can leave whenever you want, but we track it, so we force people to use it. Right? We'll be like, hey,
you want them taking time off. You don't, yeah.
Totally, exactly. And the other cool part too, well, where we're centrally located in and around the Ohio, Kentucky, Indiana area, we've got an awesome remote work policy too. So my wife and I have a ranch back in Texas that we go to 3 or 4 times a year. And thanks to the powers of the interwebs and Elon Musk, we've got Starlink out there now. And I can take video calls and podcasts and whatever and get work done, and at the same time shut my laptop and go shoot some skeet with my 6-year-old on the back 40. So that's a big thing for us, because for me, I've had 20 addresses in the last 20 years, and I don't want another address for the next 20 years, right? And when my daughter was first born, Lydia had just sold her last company, or her first company. She was at Procter & Gamble. I was at Centrifuge. We were in the startup space. There was a lot of evening events. And granted, our daughter went to bed at like 6:30, but we had like 60 different babysitters in Cincinnati because we didn't have any family, right? And so when we moved to the Louisville, Southern Indiana area, we actually moved our family with us. So my mother-in-law lives with us now. My mom and dad now live 20 minutes up the road from us. And so that's been a huge piece of work-life balance for us, is just making sure that not only for me as the chief executive, but also our team, and we press that into our team, like, go take a mental health day, like literally go for a hike, like don't just
put your phone
leave,
down,
like,
turn your Wi-Fi off, like
100%.
Yes.
Yeah. So, and it's a big piece, and we're seeing this in the news, and sadly it happened again here last week in Louisville, where mental health is such a problem, right? And it's we need to be more transparent. We need to be more communicative with our employees, and we need to understand that we're not robots, we're humans.
And we can't, and even furthermore, you get your best work. You get your best work and your best results out of people that feel appreciated, feel like they've gotten time to themselves. Because I've always looked at it this way too, Patrick. And I know we're getting close on time, so we'll have a couple more questions, but I want to make this point. I've always looked at it like this, if a typical 9 to 5 work week, right? The typical back in the day, even 8 to 5. Think about how much time you're spending away from your family, and how much time you're spending commuting. And you start looking at it that way, and you're saying, okay, that's a lot of time. That's a lot of time. Your majority of your time is actually spent either at the office or working. And so shouldn't we have the ability to spend the as equal amount of time getting what we need, right? If you start balancing that out more, and saying, hey, you need a 2-hour break, take a 2-hour break. You need a day off, take a day off, right? Then you're not going to run up against a wall of like, hey, I'm depressed or I'm down because all I do is work. Because all I do is go do my job, and I don't have the ability and the bandwidth to do anything else. And for me, like, I've got 2 daughters. I have my second now. She's 18 months old. I love that about where I'm at right now. What I do is I'm able to do stuff like this. I'm able to come podcast. I'm able to take the afternoon off, go ride the horses, right? Go on vacations. For me, I'm way more productive doing that. I get way more done, and I enjoy myself. And I think
Totally.
that's to me, like, you hit the nail on the head. That is what's important. And I think social media, a lot of social media, depending on what you take in, it's shifted. It used to be like work 16-hour days and be on the grind for 5 years straight. And you'll get where you want. And now it's like, hey, like, work really hard, get the focus in, and then get your time away, which I kind of like.
It's like an athlete, right? And small anecdote back to kind of some of the humor at West Point is when you first entered a West Point, you're called a new cadet. And we always used to joke about literally this new cadet smell. And it was just putrid. It's not because they didn't shower, but the reason honestly was chemically and metaphysically, we found this out later, is when you are overworking yourself and you are not taking rest and you are not allowing your body to recover mentally and physically. When you overwork yourself, you're burning muscle. And what muscle actually produces when it burns off is ammonia. So that's literally why these new cadets has this new cadet smell, is because they were being overworked, under nutrients, under rested, and overworked. It's the same thing that happens in our work life, right? If you literally are just grinding, you're gonna smell, your work product's gonna stink, and you're gonna eat into that muscle that you've been building, right? You have to rest, you have to get that recovery in so you can build on the muscle that you've been working towards.
I've never heard that. I love it. I'm already thinking of another clip right there. You know, if you work too hard, you're going to start to smell. So be careful.
That's right.
That's where my brain goes.
All right. Well, I think we're getting close on time, Patrick. Just a couple. We had to do a couple quick hitters. I'll hit you with one, and maybe Hayden, if you've got one. My question to you is: what advice would you give to your younger self, and what advice would you give to your future self?
Oh man, my younger self. I'll steal this from one of my mentors in San Francisco. She used to work at Lowe's and led innovation there, and then built her own product back in Sweden. And one of my favorite quotes from her was, "Build your network before you need it." So that's what I would say to my younger self, and to my future self. Man, that's tough. I think keep your eyes up. I think that's how innovation and progress and impact truly happens, is not with your head down and you not able to see the horizon. Having a healthy look at the road ahead of you, but also looking up and seeing where life and trends and business is going. Got to keep your head up.
I like that.
Love it.
We should play an Andy Grammer song. We clipped that. Gotta keep your head up. Okay.
Got a lot of good clippable scenes today.
I love Andy
Heck
Grammer.
yeah, man. He's awesome. A couple of quick hitters. Usually these are like black and white questions. Do you prefer hardware or software?
Software.
Okay.
Hardware's hard.
Yeah.
You told me that.
Cole knows that.
Yeah. Been there, done that.
Yeah. We've had many hours spent talking about that, haven't we, Cole? You got another one?
No, I don't.
Day or night? Do you have a preference?
Oh, day. I enjoy my rest and sleep. So
okay.
Definitely I'd prefer to be in the day.
Working remotely or in the office?
I would say for impact and collaboration, in the office for sure.
Sure.
Our corporate policy is actually Tuesday and Wednesday you're in the office, Thursday you're somewhere in the community, and then Monday and Friday you can do whatever.
Like in the community, like at a coffee shop or something like that.
Coffee shop, co-working space, office.
I like that a lot. That's a great hybrid approach. Nice.
Okay, last question. Let me think of a good one.
I'm looking over at you like I'm giving you all the pressure. Come on now.
Well, you mentioned skeet shooting.
He's about to sign off.
You mentioned
you're putting him to sleep. So, we're wasting his time.
My question is, do you prefer, and do you hunt? I feel like you do.
Yeah, I mean, not as much as I would like to, but yeah.
Do you prefer duck hunting or like bird hunting, or did you prefer like deer hunting?
Oh man,
that's an or, not an and.
I would probably say duck hunting, and I'll flip that on you, and I'd say fly fishing.
Okay, yeah,
because of the scenery.
Yeah,
yeah.
There's nothing more peaceful
for me. 100%. Yeah, it's not about the harvest or the kill or it is about the meat, by the way, at the end. But at the end of the day, for me, like hunting and or duck or fly fishing, I mean, it's about the serenity of all the amazing stuff that God has made and being able to take that in and feel how big that you are, but also feel how small you are in the grand scheme of things.
1,000,000%. And I'll say even more, like that's my favorite hobby is fishing. I love to hunt too, but my favorite hobby is fishing. Wish I could do more of it. Trying to plan a couple trips this summer actually. But fly fishing, you get out the stream, cold stream with your waders on, you feel it just a little bit cold, and you're just throwing the fly. And you don't care. Like every single cast, you're like, this is the one. I'll get one this time. But you don't care. You could do it for 10 hours straight, and you're like, it's okay, I'll get the next one. You end the day, you don't catch anything, and you're like, that was a successful day. I won today. And it's like, you got nothing. I'll text my wife. I'll be like, she's like, hey, did you catch anything? I'm like, no, it was a great day. And she's like, nothing. So at one point, and then we can wrap it up. I'll tell this quick story. So we did a trip up into Grayling, Michigan, up on the Asable, which is I don't know if you've been there. Phenomenal, like wild trout fishing. And we went up 2 years in a row. Didn't catch anything the first year. Like couldn't catch anything. So the second year, she's like, "Are you really going back? You didn't catch anything?" I'm like, "Yeah, we're just rookies. We're getting better at it." So we ended up going. We didn't catch anything for like 3 days straight. So we went to this hatchery and we got it. We went to the biggest, like they have like the different like ponds. So we went to the one where it was like you can catch like the record breaking like rainbow trout, right? We caught one of those and we took it out near the river and we literally got a video. I got a video of me pulling it out and she's like, you gotta send it, like you gotta send it in, like this is the most crazy thing I've ever. And it was just like we just caught it at the. I told her, I ended up telling her later that we got it at the hatchery, but she was like, "I'm so proud of you, babe." I'm like, "Yep, all this time and effort, like we didn't really catch anything."
That's awesome.
It was pretty fun.
One final caveat is the other thing that I would tell myself. We talk work-life balance and corporate rest and all that kind of fun stuff. I think one other thing that I would tell my younger self is turn it off. Often too many times we're so plugged in with email and our companies and social media and all this stuff. One of my favorite trips every year is a couple of buddies of mine. This is like 5 years ago now. I think we went to Rwanda to go help entrepreneurs over there build their businesses. And we had never met other than in Rwanda. And now every year we go back to upstate Washington. Actually, technically we're in Idaho. We fly into Spokane. But the place that we go fishing out there's no cell reception. There's no nothing. The nearest ranger station is like half an hour away. And it is so serene. And the first year it was unreal because we had like contracts with Humana and other corporate clients. I was like, I got to check my email. I got it. It'll be okay.
Right.
Like it'll just turn it off. It'll be fine. Your body needs that break. So
I love it.
Good stuff.
I love it. Well, Patrick, this has been an awesome, awesome conversation, man. Thank you for coming on.
Yeah, thanks for having me. This has been fun.
And I'll end it with this. Anybody listening, to our listeners, viewers, we're going to go ahead and I'm actually going to read through a little something so you guys have the complete details. This is about the render competition. So just reiterating, Render Capital has the render competition going on for startups. They're investing $100,000 into 8 early stage startups. And they've done this each. How many years have you guys done this now, Patrick?
This will be our 4th year.
4 years in a row, $800,000 for and they're doing it in the form of a safe investment. So it's a secure
agreement for future
equity. So at a $2.5 million post money valuation, this is an unbelievable opportunity for any startups out here locally that I think you guys should jump on. I will be posting the links and posting stuff to our social, but Render and Render Capital, you guys have some unbelievable stuff going on, Patrick, and we're super excited to have you come back on next time.
Yeah, thanks again, guys. I appreciate it.
Thanks, man.
Thanks, Patrick. Take care. God bless.
See ya.
See ya.